Mark Draper with Daniel Moore, Investors Mutual, and one of the stocks you guys have liked for a long time is CSL, the well, pharmaceutical company, the healthcare company.
Yes.
Can you give us an update for where that company's at and some of the things that you like about it and what you see for the future?
Sure. CSL is a company we've owned for a number of years, since about 2009, and what attracted us to the stock was really its competitive advantage. And what that is its ability that they operate in the plasma industry, and they can collect plasma cheaper than anybody else in the market. And that's because they have a number of collection facilities all over the world collecting plasma cheaper than their competitors. On top of that, from each litre of plasma they collect, they can create more products than any of their competitors. So when you think about that from a margin point of view, their costs are lower per litre of plasma and their revenues are higher per litre of plasma. So their margins are sustainably higher than all their competitors. So that puts them in a fantastic position. The other thing we like about the company is the management team. It's just been a fantastic management team. A lot of them are very long serving. If you really think about it, it used to be a government entity in 1994 when it floated. And today it's a $33 billion company. It's ASX 20. It really has been an incredible story. And as a bit of an update right now, what's going on is they just announced a successful 2A trial for a product called RHDL. And effectively what that is Drano for your arteries. It actually removes the cholesterol from your arteries. And obviously it has huge potential. It's mainly for patients who have had a heart attack. The sad reality is when you normally don't die of your first heart attack, you die of your second. So the idea is this product will be taken in the hospital after you've had your first heart attack and will significantly reduce the risk that you have that second heart attack and die. So it's fantastic potential, and why it's so exciting is because that product is created from that same litre of plasma. So the margins on that product, if it's successful, would be 70 to 80%. So the uplift to earnings, look, it's 4 or 5 years away, and it's not assured. They still got to get through phase 3, which is the last phase. But the potential is enormous. So a little bit of excitement there, and something to look forward to.
And a couple of years ago, there was one of CSL's competitors had an issue with their plasma products, and I guess that's one of the big risks of any healthcare company, that you do something that damages the patients rather than enhances the patients. Has CSL actually retained the additional contracts that they won as a result of that?
Yes. Well, one of the issues with transferring between products is patients' bodies don't like it. So when you do switch from one company's product to another, even though they're very similar, the body reacts badly, and that's in regards to fever or vomiting and things like that. So patients tend to be very sticky once they get on a particular company's plasma products. So when they have to switch, they don't want to have to switch back again because they go through that process. So generally, customers tend to be sticky, and once the switch has occurred, the market share stays. And we've seen that over the past 2 years. CSL had that big sort of a step change in market share, and that market share has stayed.
And finally, the way that CSL account for their R&D is also quite different from the way most healthcare companies actually operate with that, which, as I understand it, I think distorts the price-earnings ratio. Are you able to give us a couple of minutes on that?
Yeah.
Less than a couple of minutes, but...
Sure. No, that's a really good point and something we focus on a lot. If you were to look at just the earnings at the bottom line and put a PE on that, that's quite a high PE. But what it doesn't take into account is CSL spends about $400 million of R&D every single year. And that R&D is expensed. And that's expensed through that P&L. There's no capitalisation. So that really hurts the NPAT about 30%.
The NPAT,
the profit after tax is hurt about 30% because of that R&D getting expensed. So what you're effectively doing is depressing this year's earnings, and you've got future growth, being created from that R&D. So while the PE looks reasonably high, around 21 times, 22 times,
it's sort of artificially high, is what you're saying.
Exactly right. Yes.
Yeah. And I think that's one of the interesting things that one of the values of using fund managers is you can pick those things rather than the average punter on the street just looking at one number in isolation. So
as an analyst, we all have very strong accounting backgrounds and spend significant time looking through financial statements and talking to management and doing overseas trips to visit companies and clients and suppliers overseas. So there's a significant amount of effort going into the research process before we pick a stock.
Look, Drano for humans sounds fascinating, Daniel. We'll look forward to watching that one, and thanks for your time on CSL.
Thank you.
Keep an eye out for the website and the YouTube channel for more.